Hey everyone, David Trungale here from TraderTours.com. I wanted to do a little video lesson of the week here for traders or for investors. And I wanted to emphasize this point that when an investment falls, it does not, I repeat, it does not necessarily recover. Even though the consensus will tell you that if you hold on to a falling asset class and you simply wait for the long run, that it will come back in price. We have all heard that from financial planners or stockbrokers or even the investing public. Now, again, I believe that is a fallacy, and I'm going to go through a couple quick examples here of a stock or two that has fallen and has not recovered, and I would encourage you to add these to your watch list and just track it. Come back 1 year from now or 5 years from now or 10 years from now and see if either of these stocks have recovered. So again, not necessarily a prediction, but just an observation here. If you look at Citigroup, after it collapsed during the '08 crisis, it's been consolidating for 8 years, and that's a very long time. So I would be willing to wager that if it does ever recover, it will probably take a very long time to go from 46 back up to 560. And there's a pretty decent chance that it just won't ever get back there. Okay. Now, if you look at Lumber Liquidators, here's a stock that peaked in 2013, and it fell from 120 down to 15 a share. And this brings me to my second point, which is that there is a mathematical component here to overcome, and that is percentages. What people fail to recognize is that as a stock or ETF or mutual fund falls more and more and more, the percent increase that would be required to get it back to its high point is going to exponentially rise, making it very difficult. So let's walk through the math here. The drop from 120 down to 15 is approximately an 88% price decrease. And at first glance, people may think that it would have to rise 88% to get back to where it started, but that is simply not true. To go from 15 back to 120, well, that's an 8-fold return, and that equates to a 700% increase. So it went down 88%, but it would actually have to go up 700% to break even. And I can tell you that 700% returns are seldom. Lastly, there is psychological resistance to overcome. What I mean by that is we know that for every buyer there is a seller. Therefore, people were buying the stock at the absolute pinnacle. And remember, the crowd is usually wrong, so I can assure you there were a bulk of investors that also bought somewhere in here and bought during the duration of this bear market. And how psychology works is in the early stages you have the pros accumulating. At the peak you have max hype, everyone's talking about it. And this is where the rookies buy in. And as it falls, instead of cutting their losses, they go into this denial stage. But as the months or years continue, reality sets in. Now suppose this stock rose in price. There is psychological resistance to overcome, because as reality has set in, the people that bought in here would likely sell into the rally just to get out. And as they sell into the rally, that would increase the supply and knock down the demand. So the price would probably come back down. This is why these bear market rallies occur. I'm not saying it's impossible to recover. Maybe the stock will. But again, as something falls from a high point, there's mathematical resistance to overcome in the form of percentages, and there's psychological resistance to overcome from all the people that were hurt in the past.